I'm going to go ahead and get started. Is that okay, Dr. Chen?
Yes.
Okay, wonderful. Well, good morning, everyone. Thank you for joining us and for taking the time from your schedule to get educated. I'd like to introduce our fantastic presenter today, Dr. Chia-Li Chien. So thank you so much for being with us today and for sharing your information. So Dr. Chia-Li Chien, she's an assistant professor and director of the financial planning program at California Lutheran University. She serves on the boards for various national financial service associations. One of them is CFP, and she holds a doctorate in financial planning and is also CFP. To add, she wanted to let us know that Cal Lutheran is now having a scholarship for those who are seeking CFP education requirements and for those who want to become a CFP. So that's fantastic. So thank you. And on the NAIFA LA side, I'd like to let you know that we are having some upcoming events in May, June, and July. Just keep a lookout in your emails, Instagram, Facebook, Twitter, LinkedIn, and through phone calls. So we'll keep you abreast of what's happening with NAIFA LA as the weeks go on. So with that, I'd like to pass it on to Dr. Chia-Li Chien. So thank you so much.
Well, thank you, Joanna, and thank you everyone for taking time out to attend today's session. My name is Chia-Li Chien, and as Joanne have mentioned that I am a practitioner. I specialize in succession planning, and I have very honored today to share with you my experience as well as the research that I have done in the past regarding about selling a practice. And for the most part, the research, even though it was done about two years ago, but still very relevant in today's environment. So in the middle of the picture, you can see my in-laws. They immigrated to the US from Taiwan in 1976 with their 3 young boys, which is in the back row that you can see in the picture. My husband was at the time only roughly about 13 years old, and as many of you probably know that immigrants, it's really hard when you first came into the country, especially if you have a family, to just go to work. So they did like any other immigrant's family do, that they started out a business and later on became very successful restaurant business in Connecticut. When my husband and I just about to get married in the late 1980s, late 1980s, that my in-laws decided to retire. He was roughly closer, about 3 years closer to 70 years old, and he decided to call a business broker and decided to just hang a sign in front of the business and see if there's any taker. It took 1 year, has nobody interested in their business. The second year, my father-in-law suggested to 3 other business partners, they have a total of 4 partners in the business. He suggested to the partners as saying that whoever wants the business, just make an offer. Second year gone by, no interest. And then the third year, finally, the youngest partner of the business, he was at the time, about 45 years old. He decided that he's gonna buy out the other 3 partners with one condition. And that is that he has no money to buy out the other 3 partners. He said that, but the best he could do is just return their original investment in the business. The business at the time was worth $3 million. And my father-in-law's original investment was $65,000. This is over a 20 years period of time. If they were to have a proper planning in place, he would have sold his portion for $1.2 million. But my father-in-law walked away with $65,000 very, very happy because he could have just closed the business with nothing, but at least he got his money back. That's his mentality. And so today I'm going to go through and share with you that in any business, and many of you are sitting here listening to this session, many of you are in the business for yourself, whether or not you have a team or not, whether or not you have a client who is in the business or not. You need to be aware of that roughly about a third of the business in the US close out without selling. My father-in-law's business was one of those examples, very, very close to that, closing the business without cashing out. Eventually, my father-in-law was able to do an internal transfer, which means a transfer to another partner, but with very, very minimum cash coming back to them. Or you can have the third-party sales. And the third-party sales is probably, for the most part, people are familiar with. You simply call up a broker or some sort of selling agencies that they will be able to sell your party to a third party in the open market. Each one of these third section of the businesses that unfortunately that most of them don't necessarily have proper planning in place. Today, I'm going to take you through several different things. I'm going to talk about succession planning. I'm going to talk about some rule of thumbs that in terms of how to look at your business as an entity from a value perspective. I'm going to talk about a couple of different type of deals that potentially you might come across, and some practice structure that really want to make you think through how you should operate your business if you are in the long haul and eventually wanted to cash out to support some portion of your retirement. And then we'll talk about the next step. Before we get started, I have this poll that available for everyone to participate. I'm going to see if I can try to copy this, so bear with me. I'm going to try to copy this and put it in the chat box for you, so you could actually just click on it. I'm going to put it in the chat box. Bear with me. Okay, so it's in the chat box. If you want to go ahead and grab that, copy that, and then paste into your web browser, and to have that ready, so then we could have a little bit of interaction as we go through the presentation. I'm going to give you a moment to set it up. Hopefully that you have the opportunity to do that. When you set it up, you should be able to see the very first questions coming up. All right, I'm going to move on to the next page, assuming you've got the information already. All right, first question. What is the percentage that financial planning or financial services practice that do not have succession in place? What is the percentage a financial planning or financial services that don't have succession in place? So if you could enter your answer, please. You know what? I made a mistake. Bear with me. I haven't turned on my mistake. Somehow, somewhere that I forgot to turn on the poll. Bear with me. This is a live audience show, so you do expect to have, yes, Lynn?
You might want to let them know that they have to copy the link and then exit full screen so they can get to their browser.
Oh, thank you very much, Lynn. Yes, you copy the link, paste into the web browser, and then come back to the Zoom. Otherwise, you won't be able to see the interactions online. All right, so can some of you able to enter the poll now?
I'm getting there.
Well, good.
You have to agree. Do you have to agree to the cookie policy on this?
Yeah, it does. You have to agree to the cookie policy, so it will push some information down to your web browser.
It says as soon as Chia-Li 388 displays a poll, will update this area to give you the voting options.
Interesting. That's okay. Oh, great. Okay, now it's coming up.
Okay, now I got to enter my screen name.
Okay, now it's coming up. Okay, good.
Can't you just enter it by raising your hand?
Why don't you just enter it in the chat box? That's an option as well. You can put it in the chat box too. So I'm going to monitor the chat box.
Yeah, the choices are 62%, 68%, 73%, or 80%.
Okay, thank you, Lynn, for facilitating that. Wow, we have quite an interesting answers coming back. Some of you for the most part, for the majority of the participants believe that there's a high number of financial planning or financial services practice don't have succession plan in place. And it almost sounds like we are one of those shoemaker's son that don't have shoes, right? Almost sounds like that sort of situation. So let's see what is the correct answer. Thank you very much for participating in that. It sounds like everybody's having so much fun changing your answers now. Okay, yeah, the correct answer is 73%, guys. Okay, great job. At least you passed the voting section of this.
I have a question about how to vote. Is that, do you just put the number on there?
Yeah, you just click on it, that's all. Yeah.
You just click on and then just submit it, right? Because it gives you an opportunity to put 1 or 2 or 3. So I don't know if you need to put a certain number in each box.
No, just one, but that's okay. We're going to come back to do that one more time. So at least we have a practice. So thank you so much for participating in that. We'll come back in that in just a moment. All right. So that was actually a very tricky question that I asked you. And it's somewhat probably not fair when I ask you that questions. The reality is that majority of the financial services or financial planning firm don't have financial succession planning in place. There is a reason for that. And we'll go through that, and you can see that in a moment. Why is that the situation? What should you do to address that? All right, so here is the next question. This next question is, now that you have an opportunity to practice, the next question is, what do you think in terms of financial planning, financial services practice, which number of these type of practice has the majority number? For example, sole practitioner, meaning just one advisor's firm. Silo practitioners probably up to like a four partners firm, and then anything more than that is ensemble practice. By ranking them, what I mean by that is which one has the largest number of practice in the industry. Okay, all right, very good. Good. Thank you for doing that. So most of you believe that sole practitioners has the largest amount, and roughly about the same about the silo practice and ensemble practice. Let's take a look at other information to get you a little bit understanding of why am I asking all these different type of questions. Why am I asking you about succession? Why am I asking you about type of business? So thank you very much for participating in that. So let's go through a couple of things. Let's get the definition down before we actually do anything about any type of planning. So in the industry, it's very clear that the majority of the industry has sole practitioners. Or silo practitioners or ensemble practice. Let me give you some idea of the percentage. 70% of the business that we know of is solo practitioners. Silo practitioners, meaning that you have 2 up to 4 practice together, that's about 25%. And ensemble business is about 5% in the industry. So what does that mean? That means that the silo practitioners or ensemble practice, typically they have an entity structure, they have proper entity structure in place. Additionally, what they have is that number of practitioners or the advisors in their practice. Solo practitioner, typically just one person shop, that person may have a team. But silo practitioners is up to 4 advisors together, bundled together as a business. And ensemble practice actually have more than 4 practitioners in their business. The important part about team is that solo practitioner, you may have a 1 or 2 person team in place, but silo practice, they actually share the team, meaning that they share the resources to reduce the cost. Ensemble practice is actually a little bit different. They not only share the team, they also share process together, okay? And in a moment, I'm gonna tell you what's the dollar amount associated in terms of revenue for each one of these practice. The practice tenure oftentimes silo practice is limited to one generations only. Ensemble practice actually is multi-generationals because it's got more of a true entity structure in place. When we talk about succession planning are typically what we call I'm going to write this in place. Succession planning is typically your internal transfer. So internal transfer only works for silo practice, for the ensemble practices. It actually doesn't work for sole practitioners. So for those of you that indicated that a high 72% of the practice doesn't have succession planning, but at the same time, 70% are solo practitioners, that's give you an indication of people really don't know what succession planning is. So succession planning is typically internal transfer, and exit is basically a third-party sales. I'm going to write that down. So exit is typically a third-party sales. So third-party sales could be considered in the silo practice and ensemble practice as well. So depending upon where your practice is at, based on what we have just gone through, now you have an idea of what type of practice, what type of transfer is involved. Now, if you think about, this is not necessarily related just to the financial advisors practice. It could also related to your business owner clients as well. The larger your business owner's clients is, the bigger the problem could be. They may have family member, dynamic family situation, that family member in the business. So they possibly are considering succession planning, or they're possibly considering exit planning as well. So depending upon what type of owners that you have in place, how big, how small, you may have to discuss with them differently. Succession means internal transfer, exit means sell to a third party. So let's take a look at, from a business model perspective. We will not have time to go through every single business model strategy in today's session, but I wanted to at least give you an idea that this is a very simple business model canvas. I oftentimes take my clients through, make sure that their business model is still flexible, able to adapt to today's environment. As you know that today's environment, the world is kind of crazy, and you have to revisit your business model accordingly. For the most part, for today's session, I'm going to focusing just on the revenue portion of it as a discussion. From a revenue perspective, we know that in insurance, in the financial advisor, in the financial planning practice, that there are several types of revenue sources. You have commission-based. Commission could be one-time or reoccurring. Then you have this fee-based, which is typically your AUM, right? And then you have your fee only. Then you have your fee offset. Then you have your fee, hourly fee, project fee, one-time or retainer. Now, in the commission base, and many of you probably are in a commission base, what I'd like you to do is in the chat box, if you can type it in and share with me, in terms of commission-based business, which one of those will consider a higher value for a business entity if you are selling your business? Is it one-time only commission, or is it reoccurring commission? So in the chat box, simply tell me one time or reoccurring. Okay, good. Thank you, guys. Thank you for answering that question. So obviously, all of you understand the concept here. The reoccurring will tend to give you more value in your business. And so how you structure your business is going to make a very big difference. I started out associating with Lincoln Financial Group as an independent channel advisors. I have reoccurring commissions, and I was also fee-based. Gradually, I changed my business model. I'm no longer affiliated with any FINRA groups. Today, I'm not only a fee only, I'm also a fee from a project reoccurring basis. So majority of my clients, I would say 98% of my clients are reoccurring. They pay me a retainer fee on an ongoing basis. So my business also changed over time because of the fact that I have a better understanding how to structure a business entity to make it more valuable for me as an owner. All right, let's take a look at next one. So in your practice, if you can tell me, how do you get compensated? Are you fee-based? Are you fee only? Are you commission? Are you fee for retainer? So tell me, so we can kind of see where we are in terms of our today's session. Where is everybody? So it looks like a lot of folks have commission, okay? So almost everybody is commissioned in this meeting. Okay, some fee-based, okay, great. All right, okay, good. So we have fee-based, commission. So roughly majority, so it sounds like majority of the participants today are commission-based. Some is fee-based business. So thank you very much for that. So what's the reason I wanted to talk about compensation and selling factors? Because they are all related in terms of the value of your firm. So let's take a look at what I mean by that. All right. In your experience, there are several types of rule of thumbs in terms of selling a insurance practice or financial services practice or financial practice. Can you give me some example of what type of multiples of the revenue that you know of is some sort of rule of thumbs? For example, in my in-laws, they were in the restaurant business, and their rule of thumb is they take a monthly gross revenue times 10. That tends to be their selling price on the market. Okay, so some of you say 5 years of recurring income, 2 to 4 times of gross commissions, I'm not sure if it's 3 times of what. Is it 3 times of your GDC, or what is that? So there are several different type of rule of thumb selling your practice. If you don't know what that is, it probably would be good to figure it out within your network. So you have EBITDA, you have revenue and stuff like that. Okay, so let's take a look at what I have in place. Ooh, I think I have something in here. Let me get out and come back. Sorry about that. Something that is on my screen. Oh, well, I can't get rid of it, I guess. All right. So here's some rule of thumbs. We have free cash flow. If it's a free cash flow, you use 9.7 times. And by the way, these data came from many researchers in the past, specifically focusing on insurance and fee-based type of businesses. So if you're looking at strictly on the free cash flow, it's about 9.7 times. Then you have the reoccurring revenue is about 2.21 times. And you have the commission at about 1.05 times. Or if your assets under management typically is 2.1% of your asset under management, and you have your gross revenue, which could be 2.23%. These are the rule of thumbs that you are going to come across. As you look at many of these, I wasn't able to get rid of the black line on the screen, so bear with me. And the black line continued to show up, and I'm not sure what happened there. All right, so bear with me on that. Okay, so here is that rule of thumbs that hopefully now you have an opportunity to jot down those information. I do have the slide ready for you to download later on, so in case if you need to know any of these information. All right, let me move on to the next page. Before I go through in terms of the valuation, I wanted to kind of ask you a question, and you can type your answer in the chat box if possible. So what makes a real estate valuable? What makes real estate valuable? Even in this COVID-19 type of situation, the real estate is still somewhat, hasn't decreased in price. But it has a lot to do with what? So thank you, Jose, for answering that question. Thank you, Alvin. Yeah, so Jose mentioned about location and demand, yes. John mentioned about retains value. Yes, real estate still do well in some cases, especially in the metro LA area. They can retain value. Right, Rich, very good job. Yes, Stephen, great job. Yeah, they are a stable source of income regardless, right? So yeah, we all know that what makes a real estate valuable other than the demand and supply and the interest rate is primarily location, location, location. We all know that. So great job for doing that. But I'm going to ask you the same question again. So what makes a business valuable? What makes business valuable? What makes a business valuable? Type that in. See if we can get some potential answer coming in from the poll website, or if you wanted to type it in into the chat box, you can do that as well. Monte, I think your hands is up, and I did not see your hands, so I'm going to unmute you. So go ahead, Monte.
Well, I was saying prior was location and product interest, and also goodwill for the last part of the question you just mentioned.
Okay, great. Thank you, Monte. Right, so what makes business value, some of you were saying, is future cash flow, the value of the business bringing to the customers, goodwill, customer trust. Yes, very good. Your ability to retain and grow the AUM for the purchaser or perhaps the buyer, right? Size of the book, right? There are many things that is associated with the business value. So thank you very much for answering that. I'm going to switch to the next page to share with you what actually makes them a business valuable. So what makes business valuable is what we call timing, and timing. Everything you mentioned is correct, but in addition to that, most important thing is timing, and timing. What do I mean by that? Timing means that it is a personal timing. Is the owner ready to move on to something else? And many of you probably seeing other people who just cannot leave their business, right? If they're not ready, there's nothing you can do about it. You can't force them not to come to the office. The second timing is the business timing, right? Do we, as a business structure perspective, do we already have a key management team in place ready to move on with or without the owners? That's your business timing. The third timing, obviously, is the economic timing. Like today, is it a good time to sell today? In the chat box, you can tell me, is it a good time to sell today in today's environment? Probably not. In terms of, we're going to see a wave of lots and lots of business, unfortunately, cannot sustain through today's environment. And unfortunately, they might be selling. And when they are doing that, you will have more supply in the market that will push down the selling price of any type of businesses. So the timing, all three type of timings has to be aligned for the business owner in able to have a successful exit or succession planning in place. So let's take a look at, so what impacts, so what can we do in terms of, so if I go back to this chart, so two things I want you to take away is that certainly we don't have control over the economy, but you have control over your personal readiness and your business key management team. So one thing to take away from this chart is that you have absolute control of your personal readiness and a key management team in place to help you exit at some point. This is the same message for your business owner clients as well. They have control for the first two, the personal timing and the business timing as well. Economic, there's not much that we can do about it other than the fact that if the economy is good, might be a good time to go ahead and capture that and sell, but nobody knows any of those kind of predictions. So for the two things that we have control with, I wanted to share with you a little bit about what actually impact a business value. There are three things typically will impact a business value that has something to do with if you are able to reduce certain risk in your business, if you are able to employ high yield capital in your business, and third is if you can increase your recast EBITDA. all of these will increase if you control it properly inside your business. You are able to increase or decrease your business value. So let's take a look at example of each one of these. So the first one is to reduce risk. And I'm going to only talk about one item for each one of the area because there's just too much to cover in the one conversation here. The first thing that I want to talk about is customer concentration. And I'm going to ask you to put that in your chat box. Tell me, do you believe your business has a very high customer concentration or low customer concentration? Some of you probably would tell me that I have 200 clients, I have 400 clients. Sure, I'm very diverse. Tell me, do you have a good customer concentration, good or bad customer concentration? I'm going to try to see that. So Jose say 1,000%. Okay, all right. John says bad. Lynn says medium concentration. Okay. Anybody else want to share? Okay, Joanna says medium. I'm going to change my questions a little bit, and then you can tell me whether or not you actually have a good customer concentration or not. I'm going to say that if you put your customers into different buckets, the bucket I'm going to write on the screen is going to help you think about customer concentration in your business. So first group will be 70 and up. This is the age of your client. First group, 70 and up. Second group will be 60 to 70. The third group will be 50 to 60. And then you have 40 to 50 and anything less than 40. Think in terms of these groups. Think about your clients roughly. Which one of those is your most highest concentration in there? And if you have a large portion of your customers sitting in this group, I'm going to call that group A and group B. Okay. If you have them very much on that, you do have problem. What that means is that higher concentration of the business is actually not good for any business. The higher concentration that you have will decrease the value. Hence, we're talking about reducing risk in your business. The other things to remember is that our client's age is approximately 5 to 10 years either older or younger than your own age. Therefore, you look at your business customers concentration, can see that the only way you can diversify your customer concentration is to bring in younger advisors into your business. If you don't do that, chances are it will be quite difficult. Right. So Jose had mentioned about Rich and Stephen mentioned about they are highly concentrated in the 50 to 60 age group. That's great. Joanna is about 60 to 70 group. That's all great, but you wanted to make sure that you properly diversify them because you do need to reduce the business risk in that. I'm going to talk about second things. Employ high yield capital. This means that you need to improve your investment decision. What do I mean by that? Each one of us are in a business that heavily rely on technology. This is a good time. If you're not too busy at the moment, this is a good time to streamline your internal process. Streamline your internal process into some automations, into some technologies, whether or not it's a fintech or any type of technologies to help your business run efficiently. That type of investment is worthwhile making because the more you make that kind of investment, the better it is for your business value to go up. The less you invest into that kind of technology, the less value you are going to have. Think about this. When someone who is going to buy a McDonald's franchise, they're not necessarily just to buy their brand. They're buying their system. It's a plug and play system. You go in, you will have revenue coming in. If your business don't have that system in place, I am not talking about software. This is mostly under your process. If you don't have a streamlined process in place, if you don't have a team of people in place to do these work, they will decrease the value of your practice. So that's the third thing. The last thing is to talk about how do we look at increasing the EBITDA. EBITDA is pretty much closest to cash. In our business, cash is very important. In any other business, cash is important. To increase the recast EBITDA, you basically have to lower your cost of goods sold, right? And control operating expenses. Previously, we talked about if you can streamline your process, have your team work together to run a very efficient company, chances are you are able to increase that EBITDA. So this is critical for you to remember that this is something that you absolutely have to do for your business, enable to increase your business value for the right direction to be in place. All right, let's take a look at another questions here. Other than the three things that I've talked about that potentially can impact a business, what are some of the adjustments could potentially impact the selling price of the practice? What are some of the adjustments that you could potentially impact that? Thank you everyone for answering some of the questions in the chat box. Okay, so what are some of the adjustments that you can think of? Health incident, okay, very good, thank you. Thank you for that. Potentially capital gain tax, yes. Education, okay, we'll come back to education in a little bit. Yeah, thank you. Anybody else? Okay, capital gains. What I'm about to, renewal base, yes, that's your retention ratio, right? Renewal base, typically we're talking about the retention ratio of a business. Retention of the clients and staff, quality of the revenue stream comes in. Yeah, new laws, if there's any particular type of policy changes and things like that. So great job, guys. Thank you for sharing that. So let me share with you the chart that this is the chart that after I spoke to many business brokers and valuation specialists, this is what they tell me in terms of what will impact your business value. Technology platform is ranked #1. If you don't have the right technology platform in place, chances are it's not going to get the value that good people are looking for. Key person dependencies. How heavily are you as an owner be depending upon to run your business? If you are not that much dependent upon you in a business, then you're better off. Because oftentimes that if you have a key management in place, it actually will boost the value of your business. Your geographical location. The good news is that we are near the LA metro area, so geographical location is going to help you in terms of a value perspective. The quality, some of you mentioned about the quality of the revenue source, right? You mentioned that the revenue source coming in is, if it's a reoccurring and the quality of the retention, it does make a difference. Client retention risk, that we have talked about that previously. Market demand, we mentioned about if the market has tons and tons of business selling, it will press down the price. But also, if the buyers is having some sort of financing deal or not, when you have a different type of financing deal, potentially it will impact your final sales price. So the reason I show you all of this is that as you run your business, all of these are things that you need to constantly think about how to structure your business, enable to make the most out of your hard work when you are ready to cash out. All right. This one is very easy, just a yes or no. Does the selling revenue multiples of a financial service practice or financial planning practice actually correlate with the size of the practice? What I mean by that is the revenue size of the practice. Does it have any correlation at all? Okay, so most of you say yes, some say no, okay. Okay, it'll be interesting to see what is the final result in here. So roughly about 80% of you say yes, it does have correlation. All right, let's take a look at the answer that I have. Thank you very much for entering that. So this is the chart that I took by looking at the data of the actual buying and selling data. There's a company who collect these information, and I went to their website and downloaded since the 1970s all the way until 2012. All the transactions in the financial services, that whether or not there's some differences in terms of what value it matters. On the right-hand side, I have something called the specialist. On the left-hand side, I have something called the generalist. What that means is that if you find an appraiser who doesn't specialize in the financial service, who doesn't specialize in the financial advisor field, I call that a generalist. For businesses that specialize in the financial services firm as an appraiser, they tend to be able to give you a higher number of the multiples. So you can see that the larger the business, if we look at the generalist, the larger the business, this is $1 million and up GDC in here, that you have a higher multiples. So does the specialist. That tells me that if you are selling your business, who do you prefer to hire to appraise your business? So in the chat box, tell me, in the chat box, you have specialists who specialize in financial services firm appraiser versus someone who is not specialized in financial services firm. If you are selling your business, which type of appraiser would you prefer to hire to quote your market value? Specialist, okay, great, yep. So you get the point. If you're selling, you do want to have a specialist helping you to get that, because this is based on all the transactions done since the 70s up to this point in the financial services. And you can also see that the size of the business does make a difference in terms of the multiples that you're selling. And this is the multiples of the revenue. You take that times the revenue in terms of how much is worth from a fair market perspective. So you can see that in terms of the smaller you are, the less multiple you have. The larger you are in terms of revenue, the larger multiple it is. So there is a correlation between the size of your revenue and the selling multiple of the revenue. Keep in mind that that's the reason that you are working very hard to increase your revenue. Your revenue is not just a compensation for you, but it's also an indication of how much value of your business. So here is the type of business, and as I mentioned previously, we've gone through various different type of business, but I wanted to share with you in terms of revenue size. If you are an ensemble business, you are literally, your revenue, this is a revenue, it's not just the GDC is coming in as a revenue. Up to $5 million, you could call yourself an ensemble. If you are between 5 to 10, that's what we call enterprise. Then you have more than 10 million, that's a super ensemble. Here's what's the reality now. There is a big push of merger and acquisition in the market. Whether or not is the super ensemble buying this practice or buying the silo practice, or silo practice after the solo practitioner, or ensemble practice buying the silo business or solo practitioners. There's a lot of activities in the marketplace. The key is that a lot of business now has been consolidating, and the consolidation will continue to go on simply because a lot of the advisors are retiring. What I would like to remind you is be careful of a predatory acquisition. I have seen so many predatory acquisitions that I just say to them, shame on you guys. You should not do that to another fellow business owners, but that happens. What that means is that a lot of business will just take advantage of a smaller firms, not knowing the owner doesn't have enough knowledge about these business transactions, and just sign away their business without knowing that somebody took advantage of them. So really, really watch out for that. Not necessarily the bigger business will be better to buy you out or a smaller business buy you out. It's really the chemistry that you see. If there's a good chemistry in place that could continue to service your clients. That's typically what the merger and acquisition happen. People tend to look for that chemistry, so they want their clients to be taken care of after the transition. here is a recommendation if you have to look at the structure of your business. This is a recommendation that came in from a CFP board. If you have a practice, chances are you're going to have lead advisors. You're going to have a principal here that typically is an owner. Then you have a lead advisors. After that, you have service advisor, associate advisor, and an analyst. There are typically 5 different levels. And the reason I wanted to share this with you is that for some of you, as you are growing your practice, maybe you are buying other people's practice or you're growing organically, you want to have these layers in place so your team member has a good idea of what the career path looks like for them, right? So you can attract right people onto your team to continue to grow your business accordingly. So these are different levels that you should consider as you structure your practice. When you structure the practice for the financial advisors or financial planners, you wanted to make sure that I know that the commission is being compressed over the year. So a lot of business now has been converting to a base salary structure with an incentive compensation and benefits. So these are things that are worthwhile to consider. Lots of these, you can see that the incentive is associated with different level of the title or the role that you play within that structure. So these are something that you consider. So I took the liberty to actually look at, and I'm just going to kind of fast forward to share with you that if you were to look for a CFP as an employee in the LA area as a service advisors, that's the dollar amount you're looking at. That's the dollar amount that with the base salary about $102,000. Incentive bonus is about $16,000 or so. Additionally, there's a benefits associated with that, and that additional benefits could be the healthcare, could be the education, and so on and so forth. So this is how much it costs today to bring somebody in. So you wanted to be careful that you have a good process in place that the new members that you bring in is going to continue to boost the revenue for your firm. One thing that I do wanted to remind everyone as you look at how to structure your business, what I always wanted to share with people is that you need to divide your company into 2 tracks. First track is what I call the entity equity track. The second track is management track. Not every one of your employees wants to be a partner or owner of the company. So you need to separate these 2 things. Entity tracks that will bring people in as an equity partner. The management track are those people who doesn't like to be an owner, they just want to do a management job. So if you have the 2 tracks separated, it will help your employee to see where they're going to end up with. So under the equity track, you could say senior partner, partner, and junior partner. Under the management track, you can have your typical vice president, director, or manager to manage a certain type of a team in place. Now, the other things to consider is that to bring people in, just to give you an idea, the talents are really, really difficult to recruit today. There are many, many businesses that are bidding other people, that they are stealing other people's employees, if you will. It's a very difficult time to find good talents. So alternatively, you can do what we call the re-entry for people who is returning back to work or career changers. These are a good candidate to bring into your business. Internship, whether or not they are undergraduate students or graduate students, I've always recommend people to always have internship. Since I'm in the business since 2005, I have not have any gap of any interns in my office. I always have interns in the place because you can try. It's almost like you try before you buy. Interns allow you to observe if this is a good person to play a certain role in your business. And if they test out 3 months or sometime a year period of time, you decided to bring them in, that's great. But if they don't test out in that period of time, you can move on to somebody else. And so having interns, having career changer or return to work options could potentially increase helping you to recruit more people into your business. Here's the to-do list I like to recommend you to do. I like you to think about your business model in terms of the revenue source. I also like to have you think about, have you done your annual valuation yet? Some of your businesses are required to do valuation every other year. Some of you probably are required to do valuation every 3 years. But for your own sake, that if you are the owner of your business, please at least do some sort of valuations at least every 2 years or 3 years or so. So you have to pause on your business knowing that how much value do you actually worth today. So then it can help you plan. The next thing I'd like you to think about is think about your team structure. Do you have the right key management team structure in place? Remember, team structure is going to increase the value of your business. If you have a key management team in place, that means that your business can operate with or without you. That actually increases the value of your business. Once you have all that, then you really, really need to start thinking about succession and exit planning. If you don't know what they are now, then do both, because you could have the option is eventually sell to a third party, but then if you have the option to sell internally, open the option to accept both, because you might potentially have opportunity coming in. If the time is right, if the offer is right, you may have to just move on with that. So what I'd like to ask you to do now, this will be the last questions of the session. Out of the many things that we talked about, which one of the things that are you willing to implement to your practice in 1 month? Is it hire an intern? Is it look at the business model? Is it looking at your team structures? Is it looked at to hire different type of talents coming into your business? What is it that you potentially will do within 1 month period of time? Look at the business model. Okay, thank you. Anybody else? You can, if you are not typing into the website, you can also type that in the chat box. Structure and create contracts to agents and employees. Very good. So you're going to look at your business model, look at the structure, and to create certain type of contracts in place. Yeah. I know that in FINRA stage that they're still going to, besides the succession and exit plan, you still have to have a continuity plan in place regardless. Yeah, look at the business structure. So great, thank you very much. Yeah, so Stan talks about hiring, John talks about diversifying client base. Great, I'm glad to hear that all of these potentially could be an option for you in terms of working with your business. So with that, I'm going to turn the floor back to Joanne for questions. And if you have questions, you simply unmute yourself to ask the questions, and I'll do the best I can to answer your questions. So Joanne?
Okay, great. Thank you so much, Dr. Chia-Li. Thank you. So yeah, if you have any questions, please let us know. We'll check it out on the chat box. Or if you'd like to unmute yourself, you can do that and ask a question.
Hi, I'm Jose.
Hi, Jose. How are you?
I'm doing great, thank you. So this is no mistake that I'm going through what this class is about, because since December of last year, I've been having these conversations of what you're just sharing today. And good. I've acted a little bit ahead of time and being able to create what you said, the structure of it, how to
very good.
Creating with NAIFA and its people that are associated with it, trust them to know that they're going to be leading me the way towards what I really want to get my exit plan to.
Okay.
I don't want to do this again. This is hard work.
You wanted to do it once and do it successfully out.
Yes, yes.
Yeah.
I don't want to do this again, because not because I don't want to, just I don't have to.
Right, you don't have to. And you deserve to have that cash out moment successfully.
Yes.
But with that cash out moment, it needs a lot of planning behind the scene to make it work. So thank you, Jose, for mentioning that.
But my question is now, I'm in that part where I'm structuring my team. So can you elaborate a little bit more about team structure, please?
Yeah, I can. Bear with me. Let me swing back to the slide. Just bear with me. Let me copy this link for you. So let me copy this link real quick for you. I'm going to put it into a chat box. So in the chat box, I have the link of the slide that you can download. Okay, let me talk a little bit about, let me swing back to the structure of the team. Share my screen. Okay.
By the way, this type of class today of Zoom call has been the best I've ever experienced.
Oh, thank you for saying that. Thank you. I really appreciate it. Joanne did a great job. So the structure that I have, I pull out the structure of the materials here. What I would like to point out to you is that if you're really thinking about the structure, there are things that I mentioned earlier. You need to think about equity. So this needs to have a track, equity track and management track. You have to keep in mind, not all of your employees wants to be on the equity side. Some of them just want to be on the management side. So then you can decide how that structure is. But in here, these level of the structure of the team members, if you will, it has something to do with the competencies of what they do day to day. I'm happy to share with you from the CFP board, they do have this structure in place. They specify specifically what role they play for your business. What I'm going to do is I'm going to send that to Janet, and then Janet can send it out to everyone. So the structure here is giving you some idea of how you should structure. So people have a way to see, I'm going to start here, and I will move up to the associate advisors, and I can move up to service advisor is the one that they start client service. They have a client-facing role. Anybody else have a client-facing role is service advisor and up. Anybody who is associate and analyst, those are the people who stay behind the scene. So that's kind of the structure in place. Now, the most important thing about this structure is not necessarily a structure itself, is the process. You have to remember your process, Jose, your process in your business is your intellectual property. That worth a lot of money. So you need to think about, besides the team in place, do I have process or processes that can help me structure my intellectual property? Because everyone's practice is very similar. What's different is your intellectual property. Yeah. So if you can have that streamlined process in place, documentations in place, system with the people connecting, integrating together, that's going to give you the best value of that.
You're talking about
answer your question?
You're talking about copyrights and brand.
It doesn't have to be a copyright at all. It doesn't have to be at all. It will be probably very specific to you in your business.
But so how do you put a price? How do you create that process of an intellectual property to be determined, or how can you locate and ensure that to be the value of it?
So typically what the appraiser will look for, especially in the financial services, we don't have warehouse, we don't have any of that. So what we look for is processes. For example, a process, let me describe a process to you. So a client walked through the door. Before that, you have a marketing, right? First, you run the marketing, the clients walk through the door, you have a sales process in place. When the sales go through, then after the sales go through, you have a referral process in place. From a referral process in place, you have a customer service process in place. Every single module is integrated. That's process. And that works very different from company to companies. So if you have those streamlined process in place and you have a clear documentation in place and integrated with automations and system in place, that's the key. That's where the value comes in.
So where do I go to learn about this further about each? Because I'm sure that each one of us has our own different structures because we have different ways of how we've evolved in this industry.
Right. So there are a couple of things you can do. You could either go take a class about process, or you could hire a consultant to do this. I don't know if NAIFA actually has a service provider to do this or not. I typically facilitate these kind of process meeting with advisors or planners practice, or even business owners practice. So I'm happy to provide some resources for you afterwards. Hopefully that you can, if you are do-it-yourselfer, then just you can do that too. All right, thank you, Jose.
Thank you.
Yep.
All right. Do we have any other questions for Dr. Chien? Okay. Seeing that there are none, I'd like to bring Michael Morris on. He wants to promote or bring some information on Impact Hour and some upcoming town halls from NAIFA. So, oh, thank you, Dr. Chien.
Yes, thank you, Dr. Chien.
Yeah,
This
you're
was
welcome.
excellent. Thank you so much.
Thank
I
you.
wanted to just provide a couple things for everyone. I know you all like technology and like meetings. So NAIFA has been having lots of meetings online using Zoom. So I'm going to paste a link so that everyone can participate in a couple more events. These are free events to NAIFA members. And we're going to have some renowned speakers, including Joe Jordan next week. If you've ever seen him, he's definitely worthwhile. I'm going to send this to the group. And then also another person that they're going to have is David McKnight. So if you click on that link, you can see the speakers. Joe Jordan is just an industry veteran of about 50 years who's got a great message, especially in light of this COVID-19 situation. The other person, David McKnight, he talks about the power of zero and emphasizes how essentially, you know, we're taking on more and more debt as a country, and how our products and services are well positioned for that type of environment, basically to minimize taxes for our clients. So those are two events. They're an hour each, similar to this. It's free to NAIFA members, and feel free to share it with your colleagues. You know, ultimately what this is about is getting the word out, and we're only as strong as our members, so we need more members. Share the story, you know, have access to events just like this with distinguished speakers like Dr. Chien. So the other thing is next week on Wednesday, the state of California, here's a link to a free Zoom meeting as well. We're going to have an update for all NAIFA California members. It's going to include information about what's going on federally regarding the CARES Act, and also what's going on statewide with regards to some of the issues we're having with the legislature and some pieces of legislation that are coming out. And third thing is going to be more resources for COVID-19 for your clients and such. And lastly, you'll hear from people from our state board, including our state president, about what NAIFA California is doing to improve things for our members. So check out the two links I shared. Feel free to reach out to anyone on the state board. We've got state board members on the call. Actually, Rich Coffin just chimed in that the town hall sessions are available on the website if you can't make the meetings live. But we've also got our local board members, John Hansbrough, Monty Merkin, Joanna DeLosa as our president. So we're all here to, and Bobby, of course, she's there as well. So thank you, everyone. Thank you, Joanna.
Thank you very much. And thank you all for coming in for our webinar today. And again, thank you so much, Dr. Chien. It was fantastic.
Thank you for having me.
All right. Well, have a nice day, everyone. And we hope to see you again soon. Take care. Stay healthy.
Thank you, Joanna.
Yeah,
Thank you.
Take care. Yeah. Thank you, Jose.
Bye, everyone.
Bye.